All right, so I haven't made a Canadian stocks update video for a while, so I wanted to do that today. First things first, as usual, if you get value out of the video, please like and subscribe. Check out the links below. So getting right into it, I have changed a lot when it comes to Canadian stocks since the last time I've done a video. I have since sold EQB and Go Easy. As I said in those videos, I still don't mind the stocks. I still think they're decent companies. The problem is they're no longer really growing. So until that changes, I think number one, I think there's better options. And number two, it's pretty hard to expect to think that a company is going to continue to grow if it's not growing its earnings. So that's my thoughts on those companies. But getting right into it here, the first one is one I've never talked about. This is TOT.TO, Total Energy Services. They're like an oil and gas servicing company, essentially, which, again, I kind of like that, right? I think that this is an area that is going to grow, right? It's an area that's definitely going to grow. It's got a good amount of insider ownership. Analysts are very bullish. Now, again, there's not really very many analysts covering the company. It's growing its dividend quite aggressively. Now, to be fair, it did cut the dividend to zero for, basically actually all of 2021 and the first quarter of 2022. But the dividend is right back where it was before. And since then, they've actually grown it quite significantly. So I like that aspect of it. If we look at the actual business here, going back about 5 years, they've grown their operating margin slightly. They've grown their net margin almost 6%. They bought back almost 3% of their shares on an annualized basis. They've grown earnings almost 20% per year, which honestly, maybe 5 to 10 oil and gas companies have done that, which is very impressive. They've grown revenue about 7.6%. And actually, their actual PE has gone down quite significantly as well, right? Their average PE has been a little over 9. The latest PE is about 5.5. So not only are they growing quite nicely, they're actually trading at a significant discount to where they've traded historically. So if we look at those earnings, the earnings, let's go back like a decade just to see. But even at the peak of where they are at, like back in over the last decade, they're pretty much as high as they've been, right? Other than the one quarter in 2023. Looks like they had one negative quarter at the end of 2023. Something must have happened there. I don't know what, but something must have happened because that's just too much of an oddball there. This is the one thing though that is clear about this company is that if we get a big downturn in the price of oil, it will get hit pretty hard. But I personally don't see that happening, and if I do see that happening, it probably happens in the near term, meaning I just think it'll be a good buying opportunity. Like I also mentioned, they've actually been buying back shares quite aggressively, which also is good to see because, during this time, they've actually had that one negative earnings quarter, so that's good to see. If we look at their metrics here, this is also very important. Revenue per share has grown extremely nicely. Now, again, it did come down quite a bit in 2020, 2021, but they're actually higher than where they were pre-2020, right? They're at almost $25 a share. Before that, they were at about $19.50 a share. So they're growing their revenue quite nicely, which is exactly what I like to see. Free cash flow per share also is basically at an all-time high, which also is very good to see. So those are both very good points there. This company definitely does come with a lot of risk, but I do think it's probably worth it in my opinion, right? I think it's worth it in my opinion, but again, it is very risky. The next one is Olympia Financial. This is one I've talked about before. I remember making videos about this like in the mid 100s. It's up about 15-20% since I first started talking about it. And like I always mention, it's paying almost a 6% dividend, and the payout ratio is about 70%. So I still think they have room to grow that dividend. They're still growing nicely. If we look at this company's metrics here, it's grown operating margin over the last decade. It's grown its operating margin 5% per year, net margin a little over 5% per year. Shares outstanding have actually gone down. Earnings about 16.5%, revenue a little over 11% per year, and its PE has actually gone down. So it's grown very nicely, but yet the price that people are willing to pay for it has actually gone down. So I still think this company, if anything, it's trading at a discount, even though it's actually basically at an all-time high. If we look at its earnings growth here, earnings looks like they've come down a little bit, but again, we're still talking about a company that earnings are up, about 3x over the last 5 years. So I'm not concerned there. I still think we'll be okay, but again, obviously I could be wrong. But I mean, even if they can maintain this level of earnings, if they can continue to pay a 6% dividend and grow that a little bit, they've grown that dividend a little over 10% over the last decade. So that's incredibly impressive. So I still like them where they're at right now. If we look at its PE, they're about a little over 3%, its historical average. I think that's a good cutoff for me. As long as they're below that historical PE, I'm going to be a buyer. Now again, until that happens, once it happens, then I won't be a buyer. The next one is another one that I've briefly mentioned before. This is Urbana. They're kind of like a private equity / real estate company. This one has extremely high insider ownership. It is almost 58% insider ownership. That's probably the main reason that I like it, because a company that has that high of insider ownership, they have no reason not to do a very good job. And historically, they have done a very good job. Over the last 10 years, they've easily outperformed the S&P. Over the last 5 years, they've easily outperformed the S&P. So I think that's probably going to continue. They're growing the dividend 10% per year. The payout ratio is only about 10%, meaning they have an 18% free cash flow yield, almost a 20% earnings yield, which is absolutely phenomenal, right? That's absolutely phenomenal. I think that's a steal of a deal. They're trading at a massive discount to where they normally trade. So this is one that I definitely do like. I'm definitely buying this one where it's at right now. And I remember when I first talked about it, it was at about $6 a share. So it's up quite nicely since then. The next one is MEQ, which I also made a specific video on this company. It's about flat since I talked about it. I still like it. This is another one that has a massive insider ownership, almost 50%. They're basically an apartment REIT, and they're mainly focused in the West, specifically Alberta, Saskatchewan, BC, which I like that for obvious reasons. So that's why I like them. The next one is Constellation Software, another one I've talked about a lot before. This is an absolutely phenomenal company. The only problem is they are very expensive, a PE of 105, price of free cash flow 35. That's not crazy. Price of sales 7.5. Those numbers aren't crazy, but they're still more expensive than I would like them. If you could get them below a 35 price to free, below a 30 price to free cash flow, I probably would start to get interested. So we're looking at, they're probably about 20% overvalued where they're at right now, 20-25% overvalued. Like I said, they're a phenomenal company. They're just too expensive. The next one is CNQ, which I think is one of the best oil and gas companies out there. I think that they're one of the bigger ones, so you're not going to get crazy price appreciation from this company. But I mean, they're spitting out a 5.5% dividend yield. The payout ratio is 65%, so they have lots of room to grow. If we look at their numbers here, they're growing okay. I mean, their earnings are basically flat. But again, this is also, they're an oil and gas company. With the price of oil being down a little bit recently, their earnings are going to come down a little bit. But something that's quite impressive about them is that they've continued to buy back shares. I mean, going back the last few years, they bought back shares every single quarter. Their compounded annual growth rate to their shares outstanding is, let's go back about 5 years here. Actually, even just the last decade. It's actually down slightly over the last decade. The last 5 years, it's down about 2% per year. So this is another one that they do need oil to be above a certain price. If we got a massive crash, they would get hit pretty hard. But again, if that happens, it's almost certainly going to be a temporary thing. The next one is BN. This is one that I am buying right now. I do like them, even though they're basically at an all-time high. I think this is one of those companies that it's just always going to do well. And the last one on the list here for today is BAM. This is Brookfield Asset Management. I do like them. However, I think they're a little expensive where they're at right now. They don't actually have the valuation here, but I still think they're a little bit expensive where they're at. I do like them. I mean, this is a classic example of a very good dividend growth company, but I also think that they're just overvalued where they're at right now. I mean, if we look at their yields are just not where they need to be. I really do like it, but I think that it's just too expensive where it's at right now. Analysts definitely seem to agree on that. I definitely would buy it if it went down maybe 10-15%. That's probably where I would start to get interested, but that is just me. So anyway, that is what I wanted to talk about today. If, like I said at the start there, if you got value out of the video, please like and subscribe. Check out those links below and stay tuned for more.